Oh, there are so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless.
Welcome to The Explainer. Today, we're going to tackle a really important metric for any business that actually makes things. It's called the cost of goods manufactured, or COGM for short. We're going to break down exactly what it is, how you calculate it, and most importantly, why knowing this number can make or break your company's success.
I mean, really think about that for a second. If you run a factory, whether you're making custom furniture or complex electronics, what's the total cost to get a product completely finished and ready to go within a certain time frame? It's definitely not just the cost of the wood or the silicon, right? It's so much more. That question is at the very heart of manufacturing, and the cost of goods manufactured is the number that gives us the definitive answer.
Okay, so let's put a formal name to this idea. The cost of goods manufactured is the official accounting term for this total production cost. It's not a guess, it's not an estimate. It's a precise calculation that tells you exactly how much money it took to turn a pile of raw materials into finished products that are sitting in your warehouse ready to be sold.
And this definition really nails it. COGM is a comprehensive tally of every single penny you spent during that production phase. It's the total value of all the goods that made it all the way through the assembly line and crossed the finish line in a specific period. This idea is our foundation, so let's start building on it. So, to really get COGM, we first need to understand its biggest piece, which is the total manufacturing cost. The easiest way to think about this is like a recipe. There are three key ingredients that make up your product's cost, and we're going to look at each one. First on our list, direct raw materials. Now, this is pretty much what it sounds like. It's the lumber you use for chairs, the steel for a car, the flour for a bakery. It's any material that you can physically point to and say, yep, that's part of the final product. For the example we're going to use today, let's say our company spent $20 million on its direct materials. All right, ingredient number 2 is direct labor. We're talking about the people, right? The wages you pay to the folks who are physically touching the product, the person running the machine, the technician assembling the parts, the baker kneading the dough. It's any labor you can directly trace to making a specific thing. In our running example, this also costs us $20 million. And our final ingredient is factory overhead. Now, this one's the big catch-all bucket for all the other manufacturing costs. These are things that are absolutely essential for production, but you can't really tie them to a single product. Think about the factory's electric bill, the rent for the building, the salaries for the janitors and supervisors, or the depreciation on all your big machines. In our case, this all adds up to $10 million. So now we can figure out our total manufacturing costs for the period. Let's do the math. You take the $20 million in materials, add the $20 million in labor, and then add the $10 million in overhead. And boom! That gives us a grand total of $50 million. Now hang on to that number. It's the engine that's going to drive our final COGM calculation. But hold on, there's a little bit of a wrinkle here. In any factory on any given day, not everything is either a raw material or a finished product, right? There's a ton of stuff that's somewhere in between, partially assembled, half painted, still moving down the production line. We have to account for all this almost finished stuff. This is what accountants call work-in-progress inventory, or just WIP for short. It represents the value of all the materials, labor, and overhead that you've already sunk into goods that aren't complete yet. They're not just raw materials anymore, but you can't sell them either. And believe me, tracking your WIP is absolutely critical if you want an accurate COGM number. And this is where you see the continuous flow of manufacturing accounting. The value of all your half-finished goods at the end of the month, that's your ending WIP, it doesn't just vanish. It becomes the starting point for the very next month, your beginning WIP. Think of it like a conveyor belt that never really stops between accounting periods. Okay, we finally have all the pieces of the puzzle. We've got our total manufacturing cost for the period, and we understand this whole idea of beginning and ending work-in-progress inventory. So now it's time to put it all together and get our final COGM number. The process is actually pretty logical. You can think of it as a simple 3-step dance. First, you start with the value of all the partially finished stuff you had on day 1. Second, you add in all the new manufacturing costs you put in during the period. And third, you subtract out the value of whatever was still left unfinished on the last day. And here it is, the complete formula. Cost of goods manufactured is your beginning WIP inventory plus your total manufacturing costs minus your ending WIP inventory. The logic is actually really intuitive. You're just trying to figure out the cost of what you finished, so you take all the costs you put into production, and then you just remove the value of what was still left unfinished at the end. Simple as that. Okay, let's plug in the numbers from our example and see this in action. Let's say we started the period with $40 million in work in progress. Now, we add that $50 million in total manufacturing costs we calculated earlier. That brings our total investment in production up to $90 million. Then, at the end of the period, we do a count and find there's $46 million worth of goods still on the line. We subtract that ending value, and we get our answer. The cost of goods manufactured is $44 million. Now, this next part is super important because this is where a lot of people get mixed up. COGM sounds a whole lot like another acronym you hear all the time, COGS, or the cost of goods sold. They are definitely related, but they measure two totally different things, and confusing them can cause some major headaches. So let's clear this up right now.
Here's the difference in a nutshell. COGM is the cost to make. It's the total value of everything that moved from the factory floor into the finished goods warehouse. COGS, on the other hand, is the cost to sell. It's only the value of the products that were actually sold to a customer. Just remember this. COGM builds your inventory, while COGS expenses that inventory after you make a sale.
Here's a perfect example to make this crystal clear. Imagine a toy company spends all of November making toys for the holiday rush, but they don't actually sell a single thing that month. Their cost of goods manufactured, their COGM, would be huge because it reflects all that production. But their cost of goods sold, their COGS, would be zero. Why? Because nothing was sold. That one example really captures the entire distinction. Okay, so we know how to calculate it, and we know what it isn't. But why do we go through all this trouble? Why does this number actually matter? Well, because understanding your COGM isn't just some boring accounting exercise, it's an incredibly powerful strategic tool that can help you make some really critical business decisions. Let's break down why this is so critical. For starters, if you track COGM over time, you can see if your production is getting more or less efficient. It's also essential for correctly valuing your inventory on your balance sheet, which is a big deal for your company's overall financial health. It also directly impacts your pricing. I mean, how can you price something for a profit if you don't know the true cost to make it? But maybe most importantly, it's a diagnostic tool. If you see your COGM start to creep up, you can dig in and find out why. Maybe your overhead is getting too high or material costs are spiking. It turns a simple number into a real action plan. And that really brings us to the final thought here. The cost of goods manufactured isn't just some number you report to your accountant. It's a lens you can use to look at your entire production operation. So now that you know how to calculate the true all-in cost of everything you make, how might that change the way you think about your pricing, your efficiency, or your entire business strategy? It's a pretty powerful question to think about.